Assalamualaikum and greetings to all. We are first year Bachelor of Accounting students from Grade 6 in the BAC1B class. Today, we will present the conceptual framework in accounting. But before we dive into the topic, I'm sure many of you may not be familiar with what a conceptual framework in accounting actually is. So, what is it? Let me explain the definition of the conceptual framework for financial reporting. According to the International Accounting Standards Board, in short IASB, a conceptual framework is a system of objectives and principles used when preparing accounting standards for financial statements. It serves as the foundation for establishing new accounting standards and for preparing financial statements. The principles of financial information, such as usefulness, relevance, and understandability, form the basis of this framework, ensuring that it meets the needs of economic decision makers, including investors, creditors, and regulators. Our presentation will explore why the conceptual framework is essential to the IASB in developing accounting standards, how it assists preparers in formulating accounting policies when no specific standards apply, and how it helps users better understand and interpret these standards.
The conceptual framework in accounting established by the International Accounting Standards Board, which is IASB, is a structured system of objectives and principles that serve as the foundation for developing accounting standards. Its primary purpose is to provide consistent and reliable financial reporting that is useful for users such as investors, creditors, and regulators in making informed decisions. The framework helps ensure that financial information is relevant, comparable, understandable, and reliable. It also assists the IASB in developing consistent standards and prepare stakeholders to apply these standards appropriately to various transactions.
Now I will be presenting about the general objectives of financial reporting. So the first objective is to provide information to users. The goal of general purpose financial reporting is to provide useful financial information to current and potential investors, lenders, and creditors, helping them to make decisions about providing resources to the entity. These decisions include buying, selling, or holding equity and debt instruments, as well as offering or settling loans and credit. So the second objective is to facilitate economic decision-making. Business entities and their stakeholders are influenced by various interconnected factors. To make informed economic decisions, users of financial information must combine data from financial reports with relevant external information. Companies use past performance and trends to assess their current situation and predict future outcomes, helping them set achievable financial goals and allocate resources efficiently. The third objective is to monitor management stewardship. Financial information helps evaluate how well management has fulfilled its responsibility to shareholders for safeguarding and efficiently using the entity's resources. Details about the entity's economic resources and obligations allow users to identify its financial strengths and weaknesses. Last but not least, the general objective of financial reporting is to assess financial performance and position. Financial reports allow stakeholders to assess a company's assets, liability, and equity, offering insights into its economic resources and obligations. Understanding these factors is crucial for evaluating the company's financial health and long-term sustainability. This knowledge helps investors, creditors, and management make informed decisions and manage potential risks effectively. That is all from me.
I'm Tasha, and I will be presenting about qualitative characteristics. The first one is relevance. It is when that information influences decisions by users about the allocation of scarce resources by helping them form predictions about the outcomes and confirming or correcting the past evaluations. It must have value in terms of existing users in making and evaluating decisions about the allocation of scarce resources and in assessing the rendering of accountability by preparers. The second one is comparability. Information in financial statements that is provided in such way that can help users in making decisions, which by definition involve comparison between alternatives. It is expected that the information will facilitate the users to determine the relative financial strengths, weaknesses, and prospects between two different periods of the same firm or between two different firms in the same industry. The third one is understandability. It is a quality of financial information which exists when users of that information are able to understand its meaning. The ability of users to understand financial information will depend in part on their own capabilities and in part on the way in which the information is displayed. The last one is reliability. The reliability of financial information is determined by the degree of correspondence between what that information conveys to users and the underlying transactions and events that have been occurred, measured, and displayed. It is important that financial information be reliable to help stockholders make decisions and helps them to ensure compliance with regulations.
Elements of financial statement. Recognition of the elements of financial statements. Recognition is the process of incorporating in the balance sheet or income statement an item that meets the definition of an element and satisfies the following criteria for recognition. It is probable that any future economic benefit associated with the item will flow to or from the entity, and the item's cost or value can be measured with reliability. For example, assets are recognized when the company expects to receive future benefits and can measure their value, while liabilities are recognized when the company is likely to pay the debts and knows how much it owes. Income is recognized when there's an increase in assets or a reduction in liabilities that can be measured. And expenses are recognized when there's a decrease in asset or an increase in liabilities. Essentially, recognition happens when the company can confidently measure the value of an item and expect it to affect its financial situation. Next is measurement of elements of financial statement. Measurement is the process of determining the monetary amounts at which the elements of the financial statements are to be recognized and carried in the balance sheet and income statement. A number of different measurement bases are employed to different degrees and in varying combination in financial statements. There are historical costs, current costs, realizable value, and present value. The measurement basis most commonly adopted by entities in preparing their financial statements is historical costs. This is usually combined with other measurement bases. For example, inventories are usually carried at the lower of cost and net realizable value. Marketable securities may be carried at market value, and pension liabilities are carried at their present value.
The conceptual framework principles can be applied to our daily routines to improve effectiveness and organization. For example, focusing on relevant tasks ensures that your actions align with your goals, while being honest and true reflects faithful representation in communication or work. Maintaining consistency in habits helps build reliability, and comparing past and current performance allows you to track progress. Completing tasks promptly ensures timeliness, while recognizing responsibilities as they arise rather than only when completed mirrors the accrual basis principle. Finally, planning with a long-term perspective reflects the going concern assumption, helping you approach daily activities with continuity and purpose.